Welcome to our monthly view from the Edge for June 2021. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and with me here today, as he is each month, Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our most recent outlook for the global capital markets, which is based on our proprietary research model. As a reminder, the full print version of our monthly View from the Edge newsletter is available on our website at 3edgeam.com. So let's get started with a brief recap of the markets last month. And during May, global equities ended the month slightly positive returns, and actually ex-US equities generally outperformed the US equity market. Meanwhile, real assets, both gold and commodities, outperformed equities in May. As we head into June, investors are even more focused on whether the inflationary pressure from the economic rebound currently underway as the world emerges from the coronavirus pandemic will be transitory or more permanent. And quite frankly, no one knows the answer to this yet. Here in the US, the Fed's continued presence in the bond markets, including their ongoing monthly purchases of $120 billion of US Treasury and mortgage securities, has kept interest rates in check for now. However, even while interest rates remain relatively calm, it's important for investors to be aware that overvalued markets, such as the stock market and the housing market, are going to be dependent on how well the Fed is able to unwind the extraordinary monetary policy enacted in response to the coronavirus global pandemic. So let me bring Eric into our conversation, and we can start with a quick look at our View from the Edge dot plot for June 2021 for the major asset classes that we modeled. So pass it over to you, Eric.
Great, thanks, Fritz. So as you can see from the chart here, not a lot of activity. Looks like we're just seeing the US moving down a notch to neutral. And what we're not seeing is everything happening inside the emerging market equity outlook. And so we'll get into that a little bit more as we talk about the individual countries there.
Excellent. So let's dig in there. And as you said, emerging markets as an asset class looks not to have changed. But if we peel that onion away and look at some specific emerging market countries, why don't we do that? And why don't we start by looking at India equities, which the model is now considering to be attractive.
Right, that's right, Fritz. Very attractive, and it's somewhat counterintuitive based on the situation with the pandemic there. India struggled a bit more recently than most during with the pandemic, but an upcoming election and both accommodative monetary and fiscal policies indicate brighter economic prospects in the region, and that can hopefully tide things over until vaccinations can ramp up in a more meaningful way. We're picking this up in the model through steepening yield curve measures and a pro-growth rate environment there.
Excellent. So let's shift back then into the U.S. Equity market, which has shifted slightly from more positive into to mixed. And it seems to me that like the U.S. equity market is the poster child for this tug of war between the positive impact of the global economic rebound as we emerge from the pandemic, and the fear that the inflation that we're starting to see could be more permanent than the Fed is saying, and could, in the end, force the Fed's hand earlier. So what is the model picking up in terms of U.S. equities?
Yeah, the model is seeing U.S. equities continuing to benefit from accommodative central bank policies, narrowing credit spreads, steepening yield curves. We've talked about these things for several months, and that's the good news. But as we showed on the VFE, or the View from the Edge dot plot at the beginning of this, U.S. equities have edged back to mixed, and it's on the heels of last month's inflation print at 4.2%. The survey for this month's number is 4.7, so a little bit higher. And that comes out on June 10th. This would keep our outlook mixed in this region, at least in the shorter term. Rises in inflation like this are a risk to an overheating economy that historically leads to some type of intervention to cool things down a bit. Chairperson Powell has doubled down on this inflation being transient and has vowed not to do any rate increases until 2023. But even a hint regarding a change to that messaging, indicating a sooner than anticipated tightening, could send the markets down. And let's also not forget, as we've talked about for many months, that U.S. equities remain very overvalued by our measure as well.
Right. Absolutely. All right. Let's maybe look at both Japan and Europe, since our research indicates that they are slightly more attractive than the U.S. Equity markets. What are we seeing there in those two developed markets?
Sure, yeah. Japanese equities remain attractive. They should continue to benefit from their relative undervaluation, narrowing credit spreads, steepening yield curve measures, and positive investor psychology. Many of the things we've been saying for some months now. The global economic recovery that's underway should benefit many of Japan's largest companies too, since they tend to export their products worldwide.
Excellent. No, I'm sorry. Go ahead. Finish.
Yeah, sure. Yeah, I was just going to go ahead, move right into Europe. And so with regard to Europe, like in the US, European companies should continue to benefit from continued extraordinary monetary and fiscal stimulus that's underway in the region as they try to combat their somewhat slower recovery. Also, a continued rotation from growth equities to the stocks of more cyclical companies that are tied to the real economy should continue to be a positive for Europe. And we are also watching inflation in the Eurozone, it's worth noting as well, because this seems to be ticking up lately, and that could be a catalyst in the near term for a downward move in our outlook to mixed, if that does manifest as well.
Absolutely. And then one last equity asset class is China in the emerging markets. What is the research showing us about China currently?
Yeah, so the model outlook there is more mixed. Chinese companies have benefited from accommodative monetary policies, and we've seen this in recent price momentum measures alone. But the recent uptick in U.S. inflation that we just talked about and the elevated level of U.S. Treasury yields relative to where they had been some months ago, along with the recent strengthening in the Chinese yuan, that neutralizes this overall outlook in the shorter term, at least.
Excellent. All right, so let's shift gears into the bond market and rates and credit. And as I mentioned earlier, recently the bond market has been quite stable, and even as these sort of warnings about inflation seem to be picking up across the board. So what is our model research indicating in terms of bonds?
Yeah, still maintains a somewhat negative outlook on fixed income. We've noted in the past the risk reward trade-off in bonds, particularly treasuries. It just isn't there in our opinion. The vast majority of the treasury yield curve, yields less than the expected rate of inflation for that duration or tenor, suggesting just locking in negative real returns. So not very attractive. And then as for credit, spreads do continue to narrow, and it really doesn't seem like there's much juice left to squeeze. So the risk of an unwind and therefore, a drawdown associated with an unwind like that just outweighs the benefits for the very small pickup in yield that one might get. Yeah.
An interesting piece of news on that was the Fed's announcement that they were going to unwind these corporate bond purchases that they had made very early on in the pandemic. Their claim is that, well, those are, investment grade corporates and it's not related to any of this, but I don't know, maybe a hint.
Could be a hint. That's right. Yep.
All right, great. So let's switch to real assets, both commodities and gold. And both commodities and gold enjoyed actually a strong period of performance in the month of May. Gold has now recovered most of the declines that it suffered earlier this year. But what is the current outlook according to the model for real assets?
Yeah, well, as they say, don't fight the Fed. The Fed meets in the middle of this month, June 15th, 16th. If the Fed sticks to their messaging about inflation being transient, and if the market believes it, and then whether or not inflation actually is transient or more of a permanent fixture, gold and real assets more broadly could benefit. And we'd likely see a continued weakening of the dollar. If, on the other hand, the Fed indicated some talk about tapering, or even talking about tapering in some fashion, we could see gold and real assets take a pause as the markets digest that new information. From a modeling perspective, gold continues to be supported by negative real interest rates. That is the nominal rates minus inflation expectations, which have been holding in the negative 80 to 90 basis points range for some time now. And then, moving into commodities, they too remain attractive. There remains this long-standing relative undervaluation of real assets, and the prospect of a strong global economic recovery in the second half of this year, as well as prospects for a weaker dollar, which we've discussed. All of these contribute positively. And then there's other positive factors on top of that too. The appreciation of the Chinese yuan, narrowing credit spreads, steepening global yield curve measures, positive investor psychology. So there's a lot, working in its favor right now for commodities.
Yeah, clearly, very interesting. And there's a lot of talk, very smart investors that this is the beginning of yet another commodity run up in the commodity super cycle. So remains to be seen. But great. So thank you for getting us caught up with the highlights from our June View from the Edge. Again, the full View from the Edge newsletter is available on our website at 3edgeam.com. So that will do it for Eric and me. We'll be back once again in early July with the next edition of our View from the Edge. Meanwhile, Steve Cucchiaro and I will be back at the end of next week with the latest edition of the 3 Edge Week in Review. As a reminder, all videos that we make are available on our 3 Edge YouTube channel and at our website. And again, that is 3edgeam.com. Also, please feel free to share these videos if you think someone you know might be interested. So on behalf of everyone here at 3 Edge, have a great weekend, and thanks for listening.